session. My name is Abby Gonzalez. I'm the Economic Development Specialist with the U.S. Small Business Administration in our Houston District Office. Our presenter for today will be Easter Wright, who is also an Economic Development Specialist. And we also have Dr. Portia Jackson from the City of Houston's Office of Business Opportunity joining us. For those of you who joined us yesterday, this is the second session in the Ready, Set, Go webinar series. The Ready webinar yesterday explained the basics of starting a business, some things that you should keep in mind if you're looking to start your own business, how to access resources, and other information. Today in the Set module, you'll learn about business financials, how to access a loan, what is credit and why is it important, and other information related to business financials. So we did share yesterday's presentation and the recording. If you need a copy of that still, make sure you let us know. We'll make sure to put our contact information in the chat box. And we'll do the same for today's session. Tomorrow, the third session, is the final session of the Ready, Set, Go workshop. So make sure you join us for all of them. And a final reminder that we will be here at the end of the webinar for 1 hour to work with you all on the information that we discussed today and yesterday. If you have questions from yesterday's session, we are happy to help you with those so that you're really putting all of this information into action. So if you do have questions throughout the session, make sure you write them down so we can have a discussion after the webinar. So without further ado, I'd like to introduce Dr. Portia Jackson of the City of Houston's Office of Business Opportunity for her remarks.
Good morning, everyone. Again, just happy to have you here and be in collaboration with the Small Business Administration on this webinar series and to help make sure we help you all in starting your businesses. The Office of Business Opportunity is here for you. We have a plethora of resources, so if you have questions on anything about starting your business, we are here to help connect you and to make sure that you have the opportunities to start your business and grow your business. And I'll also type in our website into the chat. There you can find out all about our small business development programs, as well as some resources that we offer. In particular, we have free legal counseling for up to an hour that will help you if you have any legal questions about your business and how to get that started, as well as if you have any questions about the pandemic and how it affects businesses on a legal aspect. That information is there. We're here to help you, and glad you are tuning in again for day 2, and we look forward to seeing you in day 3 as well. Thank you.
Thank you, Dr. Jackson. And we now like to introduce our presenter for today, Easter Wright of the SBA Houston District Office. Easter? Oh, we can't hear you, Easter. Looks like she's reconnecting. Give us just a minute. No, still can't hear you. I can see your video, but can't hear anything.
Testing.
There you go.
Okay. Good morning from the United States Small Business Administration, SBA. I'm Easter Wright, and I'm here to talk to you about the second phase of our series. SBA is a federal agency that was created to aid, counsel, and assist. So we are available to assist you, the small business, and you do have to be a small business to take advantage of our programs and services. But we are available to help you, the small business. It doesn't matter if you're starting a business, are you trying to grow your business, expand your business, are you trying to recover, SBA is available. We talked about the Ready module yesterday, and today we're going to talk about the Set module. Yesterday, you learned that the basis of setting up your business doing the Ready module, and now you're set to get started. But you need money. You know, we all need money. We need money to do whatever we need to do. So that's what we're going to talk about today. Among the topics, we're going to cover possible sources of business funding, what lenders look for in a loan applicant, those 5 C's of credit that you probably heard about, what a credit score and why it matters. We're going to talk about what's included in a loan application, including the business plan and cash flow and the assumption. And we're going to mention predatory lending practices as well. Where to get money to start a business? That's a huge question, and we hear this question every day, all day. Well, you can start with your individual personal savings, which can include your retirement funds and or money given along to you by your family or a friend. You can find an equity investor, which may result in giving ownership, interest in your business. Or it can be money that you borrow personally, usually through a home equity line of a credit and a credit card. Well, from the business side, you get money from an investor who gets a share, a piece of your business. There's crowdfunding. So there's several things that's available to you, several options that that we probably don't think about. For example, crowdfunding. Money that you borrow of other local lending programs could be available for you. Or you can get a business loan from a banker or a lender, including a loan supported by the SBA. So these are some of the options you'll find. And you'll also find that we have this information also, the loan information also on the Houston District website. Getting a business loan, that's going to be a huge topic today. Where do you start? What does a small business owner need to do to get a bank or other lender to say yes to a loan request? And that's the focus here. Ultimately, that's where you're trying to get to. You're trying to get that lender to say yes. And we want you to be lender ready. That's very important. That's things that small business doesn't think about. But you do have to be lender ready, and we have resources in place that can sit down with you and help you determine if you are lender ready. Introduce your business to a lender. The first step is to communicate with the bank about your business. Determine the correct contact at the bank for small business lending. What is the bank's minimum criteria? Often this can be located on the bank's website. Ask about loans the bank may provide. If you're in a rural setting, you're a rural small business, that's really important for you. It's a significant aspect of your financial preparation because if a business is in a rural setting, they tend to have a few more challenges than businesses that are not in a rural setting. So we want you to build that small business relationship with your bank. The takeaway here, the only thing a potential lender knows about your business is the story that you tell. So it's all in your hands. What you need to do, what you need to know about a non-traditional lender, loan sources other than banks. There are other loan sources other than banks. There are micro lenders, there are community-based lending programs. There are non-depository lenders, such as SBLCs, and that's what SBLCs are called, non-depository lenders. Of course, depository lenders are the banks that we see and know in our daily lives because that's where we deposit our money and our savings, our check, and our retirement account. But there are non-depository lenders also that you can explore. And then there are online lending platforms also, so don't discount that. If you look to the right, there are resources listed here, and these resources are considered to be a community-based lending program. They do lending, but they are considered to be community-based lending program, which is HBDI that's listed first. Secondly, it's listed is Lift Fund. thirdly, people fund is listed in their contact information. And then the alliance is listed. And last but not least, True Fund is another community-based lending program that's available to you. And notice I'm using the word program because these are programs that receive funding to assist you to small business. A microloan is usually less than $50,000. And the advantage of a microloan is it has more flexible credit requirements. It works more closer with the borrower. They provide technical help. The microlender understands the conditions of the local community and how that may affect your business operating in that community. They lend in underserved markets that lack the ability to secure traditional financing. And I think this last one is a really strong factor here. The lend in underserved markets that lack the ability to secure traditional financing. That's the focus of the micro lenders. So we want you to know those micro lenders are available to you. And the micro loan program was created because banks tend to not want to lend less than a certain amount. So a program was created to assist you, and it's called micro loan program. SBA micro loan program relies on the community-based organization. And again, those community-based organizations of the institution that you just saw, like the HBDI, the True Fund, the Lift Fund. SBA has a loan program, and let me pause here and let me backtrack a bit. If you're not familiar and if you don't know, that's one of the things that SBA do is that we have a loan program, a small business guaranteed loan program. That's the name of it, SBA Guaranteed Loan Program. While we don't make direct loans, we have a group of lenders that we have given authority to make the loan to you, and SBA guarantee the loan. What you have to do is go to that lender. You don't come to SBA, you go directly to the lender, and the lenders are listed on the SBA website. You go directly to those lenders and you tell them that you want to apply for an SBA guaranteed loan. And that's the purpose of this whole module today, to give you the mindset and the focus that you should have so that when you get ready to go to this lender, you'll get a yes and not a no. Even for SBA loan program, you still have to qualify. You still have to meet and consider all of these things that we'll talk about here today. You can't get around that regardless of what program you're going to use. And these are not grant programs, these are loan programs. And the SBA Guaranteed Loan Program, very similar, like VA, for example, the Veteran Administration, VA, guarantee home loans for veterans, where SBA operates similarly, that we provide a guaranteed loan for small businesses. And the takeaway here is non-SBA micro loan program also may be available in your community. So make sure you reach out to, if you're looking for a small amount, 50,000 or less, explore that micro lender. No matter who you ask to lend you money, the lender will be looking for a business owner who knows the business, has the ability to run it well, and is willing to work hard to make it succeed. A business that is financially sound, or if it is brand new, appears to have the ability to make enough money to pay its bills, give its owners an income, and pay back the loan. Because keep in mind, we tend to forget that banks are in business to make money. They are not in business to lend money to you, the small business. They are available to make money. So we tend to forget that. So that's why you have to be bank ready, because the bank will not lend money to you just because you are a small business or a minority business or whatever the case might be. The bank is going to look for collateral to cover at least part of their lending risk, because they're going to evaluate the risk. based on certain factors. All the factors that we're talking about today will help the lender determine how much risk the lender is taking. And the lender is going to look at an investment from the business owner or equity injection. That's what an investment, when you put your money in your business, the lender calls that equity injection. Usually the business owner's own money that gets put into the business to pay for some of the things. And the definition of collateral is something of value, an asset, or property that a borrower pledges when getting a loan. So you do have to have collateral. Now with SBA Loan Program, we do require collateral also. So, and again, each bank is different. So let me say this, even though SBA guarantees the loan, ultimately it is the bank decision if they are going to lend you the money. Ultimately, it's the bank decision to determine the terms and conditions of the loan. The 5 C's of credit. Well, lenders are looking for, commonly known as the 5 C's of credit: character, condition, capacity, which is the cash flow, capital contribution, which is the injection I just talked about, and collateral and guarantee. Well, let's start with character. Character is your personal reputation and general impression you make on your lender, your integrity. A lender considers who you are, whether you have lived in your neighborhood for a long time, or whether you have just moved in, whether you have an account with the bank, and whether you have ever had a loan from the bank or other lenders. They're going to look at your management experience in the industry. What do you know about that industry? What type of education do you have in that industry? What's your past experience in that industry? And they're going to look at your past credit history. That's part of your character also. And they're going to look at your banking relationship and your repayment history. All of that is considered to be part of your character. Personal credit scores are an indication on the ability or willingness to repay. Therefore, it impacts the character in the 5 C's of credit. You know, how you pay your bills. This information is reported by the credit bureau, so they're going to be looking at your credit report. That's where they're going to get this information from. Bad credit usually means the loan will be turned down. Small business tend to get upset when the banks say no. But if you have bad credit, the bank is going to say no. They're going to look at your experience in running a business and the type of business you are starting. How do you find out how you would look to a lender? Well, order a copy of your credit history and your FICO score. And these are the credit reporting agencies listed here. They're very common and known. Equifax, TransUnion, Experian, and all 3 of the credit reporting agencies are required to provide a free report to you annually. And this is what the website is listed here at the very bottom, www.annualcreditreport.com. Now, your FICO is a credit score calculated from both your good and bad information in your credit report. How much money you owe compared to how much money you make, how much money you owe on personal and business loans, other credit factors such as if you pay your bills on time, if you have ever had a judgment or filed bankruptcy. And the pie chart to the right is like a general rule of what the lenders, basic, I guess you say a basic requirement, a starting point for the lenders. They're looking for, they don't want you to be your percentage amount owed to be more than 30%. Payment history carry about 35% weight. The types of credit in use carries about 10% in weight. Length of credit history carries 15% in weight, and new credit carries about 10% in weight. And again, it's different for each bank, but this is just a general guideline. A higher score means less potential risk for lenders. So the higher that credit score, that FICO score, higher the score means less potential risk for lenders. Lenders use the FICO score as one factor when deciding whether to approve a loan, what the terms and conditions of that loan is going to be, and what your interest rate is going to be. And of course, the interest rate is the cost of the loan to you. Some things can be fixed. So that's why we want you to pull that credit report, see what's on there, and try to get it fixed before you go to that lender. Review the report for mistakes. Everything that's negative on your credit report isn't necessarily correct. That's why we want you to review it for mistakes. If any mistakes are found, contact the creditor in writing to ask to have the report fixed. Contact the credit bureau in writing to find out how to correct wrong information. All 3 credit bureaus accept disputes submitted online, so it's pretty simple now. Back in the day, you had to write a letter and wait for the letter to arrive to the credit bureau, but now you can do it online. Provide copies of that letter to your lender. If the report is correct but negative, still try to fix it before applying for a loan. If that credit score is low, it's low because some things happened in the past. We understand that. We all have that experience at some time in our lives, but try to fix it. You try to fix it by making sure you pay your bills on time, if not early. And when you start trying to fix it and doing some things to improve it, make sure you monitor and make sure whatever you're doing is working. Make your credit payments on time. Reduce the amount of debt you owe. Try to pay some things off if you can. And if necessary, work with a nonprofit that will provide free credit counseling. That's a great tool for you. If you need it, make sure you take advantage of it. Well, now we're going to talk about capacity, which is also the cash flow. Whether your business make enough money to pay your bills, including the new loan. The amount of money that you make or expect to make is your cash flow. That's the definition of cash flow. And it should be sufficient to pay all the expenses and allow a little extra in case something unexpected comes up. And we all know about that unexpected comes up. It happens all the time. It's just a part of day-to-day life, okay? There's always gonna be something unexpected comes up. But if you have prepared for it, it would impact your business less. And maybe when that unexpected comes up, it's not so devastating that it fail your business. Because we don't want your business to fail. We don't want you to put all that time and money into your business and fail. So that's important also. The takeaway here is capacity and cash flow is the most important of the 5 C's because it measures whether you can pay back the loan. Because again, like I've said a couple of times, the bank is in business to make money. They're not in business to lend money to you just because you are a small business. If you are an existing business, the lender will look at how much money you have made in the past. In other words, your historic cash flow as shown in your business, financial statements, and tax return. Usually the last 2 years plus your current year to date. And last 2 years, they're talking about your business financial statement. Current year to date usually means if you're going to apply for that loan, for example, on June 5th, and your business fiscal year is on a calendar basis, for example, from January 1st to December 31st. Well, when you prepare that year to date, you will prepare from January 1st, for example, 2020 to July 5th, 2020, or to whatever date that you're applying for the loan. That's what year to date means. And of course, the last 2 years of your business financial statement. And that business financial statement, you'll get to see in a few, that's your balance sheet and your income statement. If you're just starting your business, the lender will rely on your business plan, your estimate, which are the projections that you're going to have in that business plan of how much money you will make, which is your revenue. The money you make is called revenues and our sales. Revenue and sales is the same thing. And how much money you will need to spend, which are your expenses. Collateral guarantee. Those two are the same thing, basically. Collateral is something of value that you own or will buy with money from the loan that you can pledge to secure a loan. Most lenders also require the business owner to personally guarantee the loan. And a personal guarantee is a promise to repay the loan even if the business fails. That's what the definition of a personal guarantee. If a personal guarantee is a promise to repay the loan even if the business failed. And also, that's something we want you to consider when you're deciding to open that business and deciding to get a loan for that business. If something happens, will you be willing to still pay that loan even if that business is no longer around? Well, business network. The definition of business network is what the business owns, which is called assets, minus what it owes, which are liabilities. So assets minus liability equal net worth. And it's calculated the same for your business and it calculated the same personally. And the again, capital / contribution includes money you have invested in the business. Show your commitment to the business and what you have at risk if the business fails. A lender expects you to have contributed something to the business, which is, again, that's the definition of equity injection. In other words, have some skin in the game. Equity injection varies based on the lender or financing source. Be prepared to provide at least up to 30%, anywhere from 10 to 30% for contribution, especially with traditional lenders. Lack of equity usually means the loan will be turned down. So keep that in mind also. Well, now we're going to talk about loan conditions that a lender considers when approving your loan. And those conditions include loan amount, interest rate, what you will use the loan for. For example, are you going to buy assets like real estate or equipment? Is it for inventory or working capital? How well people are doing in your community. That's a determining factor also when that lender is trying to decide if they want to lend that money to you, and how well your business industry is doing at that particular time. Prepare to ask for a loan. You have to prepare. You have to do some work. You have to prepare to ask for a loan. You can't just wake up one day and say, I'm going to ask for a loan. There has to be some work going into that preparation. Asking for a loan to help start or grow your business can be intimidating, but you can help your chances for success by being well prepared. And that's what all of this is about, from slide 1 to this slide here. We want you to be well prepared, have a thought out and a written plan, what the steps that you would take to get started or get through your next growth phase. Telling your story well. Help your lender get excited about your dream and believe that you will succeed. The takeaway here is be very honest in your presentation of yourself and your business. Lenders don't want to just hear the good thing. They want to know about any weaknesses too. In other words, give them a very accurate snapshot, show them the good, bad, and the ugly. Prepare to ask for a loan, meaning you need to have a strategic plan. A strategic plan is a business plan. That's what it is. Strategic plan based on a strategic plan shows where you are now and where you are going. You'll include information about the owners and key managers, and you'll have those projections in there. What his cash flow is going to look like. All of that is going to be in that plan. Your marketing plan, all of that is going to be a part of it. The basis of your loan request is how much money do you need and how will you use the money? Well, let's go back to this very first question. How much money do you need? We get phone calls on a daily basis where a business say, how do they determine how much money they need? Or they would say they don't know how much money they need. You have to know that. So that's why we're going to send you to those resource partners that SBA have in place. And you're going to see who those resource partners are very soon. Are you going to use the money for real estate, equipment? What are you going to use the money for? Do you need working capital? Do you need money to help pay your daily expenses like rent, utilities, salary, inventory? What are you going to use the money for? All of this is just the basis of a loan request. This is just very basic information that you need to be able to provide. Now let's go talk about that applying for a loan phase. What type of loan are you seeking? A term loan, which is going to be a fixed amount of money that you will pay back during a specified period of time. A revolving loan. A revolving loan is arrangement to withdraw and repay the loan on an ongoing basis until their arrangement expires. Or when you get a line of credit, which allows you to borrow up to a maximum amount of money, repay some of it and borrow more up to the maximum loan amount. So when you talk to the lender, that's not something you necessarily have to know or need to know. We're not saying before you go to the lender, you need to know what type of loan you need to that you're going to apply for. But all those other things that we have mentioned, yes, you need to have those things in place. Now, it's the lender will help you determine, based on that lender appetite for that industry and for that community. The banker will help you determine what type of loan is more conducive to what you need, or what type of loan that bank is willing to give. So you don't have to figure that part out. The bank would determine that, what type of loan it would be. Some businesses, especially rural businesses, have seasonal operations and can benefit from a loan structure according to annual cash flow. Seasonal finances typically means that business pays smaller payments in the off season and larger payment during its high season. And some of those businesses are tourism, agriculture, hospitality, sports, just few of the examples of those seasonal business. How will you pay the money back? How much can you afford to pay each month? How many months or years will you need to pay the loan back? That's what we call the loan maturity. The amount of time that the bank give you to pay the money back, or financial institution give you to pay the loan back. That's called loan maturity. That deadline, that up to date, is called loan maturity. Do you own anything of value, such as real estate, that you can pledge the lender to support a loan? How much is what you own worth? Because that's going to determine also if the bank is going to use that collateral that you have. If that bank is going to allow you to pledge it as collateral, the valuation of that pledge is going to determine also how much money the bank will lend. The bank, I mean, if the item that you're pledging is worth $10,000, but you're asking the bank to give you a loan for $50,000 based on that collateral, that's an imbalance. What is your company financial condition? Can you pay all your bills every month? Are you paying your bills on time? Do you ever write checks for more than you have in your checking account? A lender will review average collected balances. And that's the purpose of that income statement that was mentioned earlier. When I said the definition for income statement is the balance sheet and income statement. Financial statement. The lender's going to look at that financial statement, and that's your income statement and your balance sheet. That's why they want that along with your tax return, because these are the things that the lender is trying to determine. What do you look like on paper financially? What are you doing or not doing? How much money does your business really need? And I know sometimes a business can't make that determination. They can't figure that out. I know that because they call us, and that's okay. That's, you know, the resource partner can work with you and help you figure that out. Part of the question is that anything that you can't answer is seek help from a technical assistance resources in your community. That's what it's all about. We know some of these questions are hard, and we know sometimes you can't figure it out. If a business just getting started, you need to consider all business needs during the startup period. You're going to consider short-term needs and long-term needs. Your cash needed minus the money that you have put into the business, which is your equity contribution. That's going to be your loan request, and resource partner can help you figure all of that. Your strategic plan. Here, this coming up again. Basically, this is your business plan. One of the most critical documents in your loan application. Helps you to think about all the details of how your business will operate. It serves as an action plan to manage, organize, and sustain your business. It helps you to identify and define your target market. You have to know your target market. Help you to plan and anticipate future capital needs. It also helps you to demonstrate how you will make money. And also that strategic plan will tell the story of your business to others, including potential lenders. The strategic plan will also be a very important document or a very important tool if you're seeking investors, because they're going to look for the exact same thing. So that strategic plan slash business plan is very important. And yesterday, I'm not sure if you were on yesterday, but we did point out when we were talking about strategic slash business plan, we pointed out to you that it doesn't have to be 30 pages. It needs to tell your story, but there's nothing that says it has to be 30 pages. And also keep in mind, within the climate we live in today, people tend to have less time to read things because thanks to technology, we receive a lot more and you're expected to read a lot more in a day's work. So keep it simple. It's sweet and simple. We want the lender to have time to read it. We don't want the lender to say that's too much, because again, that's a mindset. Thanks to modern technology, social media, we receive information every second on our desk that we stop and read. So keep that in mind. It's no different with that loan application when it arrives on that lender's desk. So don't fill your business plan with a bunch of words just to make it look like it's really long and full. Tell your story as easy and as quickly as possible. If it's on the 5 pages and it gives the full picture of your business, that's okay. Because one of the bankers in our office, using an example, that when he was working, doing banking and looking at applications, if that business plan was 30 pages and he had a business plan that was on the 5 pages, he tended to go to that business plan that was 5 pages first and go back to that 30-page business plan later on. So keep that in mind also. Now we're down to the resource partners that are available for you. And this is again, to give you a general idea of what your mindset should be and what you should be seeking. We want you to seek, of course, the SBA district office. We're available to point you in the right direction. That's what we do. We try to help you find the information that you need. Try to get an accountant or bookkeeper. If you can't afford one, okay, go to the resource partner and ask for someone, a mentor there that has that experience. If you need a lawyer, also go to those resource partners, see if someone has the lawyer experience, or a banker or lending experience. Because many times at these resource partners, there are mentors that has experience in these areas. Business consultants, micro lenders also provide technical assistance. They can assist you also. And then you have your city, county, state, and economic development resources. So seek expert advice. That's what we're trying to say. I don't know, small business tend to think, especially the ones that have a master's and a PhD in business, they tend to think they don't need any expert advice. They know it already. The only thing they need is that loan or contract. Well, we want you to reconsider that. Do seek expert advice. If they tell you something that you know already, oh, that's okay. But they might tell you something that you haven't thought about or that you weren't aware of. And so you have nothing to lose. And these resource partners are free. Your taxpayer dollars are paying for it. They're available for you, so you might as well take advantage of it. And the resource partner are SCORE. SCORE have mentors available to assist you. Small Business Development Center have about 14 networks. Of course, that doesn't matter now because we all are owning and operating online. We're not doing any face-to-face business, but hopefully when we get out of this pandemic, which hopefully is going to be soon, you would have already established a relationship to a mentor, to a small business development center that's closest to you, that's convenient to you, because at some point they'll start taking a face-to-face client after we get through this pandemic maybe. And then there's a Women Business Center that's available. There's one in Houston, and the Veteran Business Outreach Center. All of these resources are listed to the right here in blue, and all their contact information is available. So just go to their website and seek assistance and tell them what you want assistance and what areas you need assistance. Financial information. I've mentioned this already a couple of times. What you need on the financial side of the house when you get ready to apply for that loan. You're gonna need a balance sheet. You're gonna need your tax returns. You're gonna need an income statement. And you're gonna need your projection and assumption. And our projection assumption, that's the section in the business plan or strategic plan. That's where that's located. Again, the resource partner can help you to understand how to create those projections and assumptions. A projection assumption is nothing but a guessing game. You're basically telling that financial institution, this is what I plan to do. This is how much money I plan to make on a monthly basis. This is what I expect my expenses to be. This is what I expect my sales to be. That's what those projection assumptions are. Again, you are guessing. How far back do you need to go? Typically, it's 2 years. Can you put this together on your own? Possibly, but this is where expert assistance is really important. If you receive assistance with your projection, make sure that you understand and agree with them and can explain them to a lender. And this very last bullet is very important. Make sure you understand it. Well, the resource partner are going to collect the information from you. They're going to help you. They're not going to do the projection for you. They're going to help you do the projection. But make sure, even though they're helping you, make sure you understand that help. Make sure you understand how they arrive with the figures that they recommend to you. Because when you get in front of the lenders, those resource partners will not be with you. So it's up to you. Back to telling your story, but you're going to have to tell your story and use your projections to tell your story. So you need to be well rehearsed. Make sure you understand it so you can tell your story to that lender. Having good financial system is critical. Make sure all your taxes are paid as required. If you owe IRS, make sure you have a workout plan with IRS, and make sure you are adhering to that workout plan. Just having that
Lost sound.
I think Easter is frozen just a second, so she can log back on.
Hi guys, sorry, my internet dropped for just a second. I'll be sharing the presentation once again momentarily. Portia, are you able to make me a co-host again so I can share my screen, please? Okay, Easter, do you see the presentation again?
testing.
There you go, I can hear you now.
Okay. It's important that you have a good financial system in place. Make sure all your taxes are paid, or if you can't pay them, make sure you have a workout agreement with with IRS. And also you have to, whatever that workout agreement is, you have to approve that you are following that workout agreement. So that's important also. You can't be delinquent with any government debt. Can't be delinquent on your school loan. So make sure you have all those things in order before you apply for a loan. You have to make sure if you have a staff, make sure your payroll taxes are paid, because the lender will check. Lender know what they need to know about your business operation, because that's what they do. So they know what to look for. Accounting and bookkeeping software is available to help you set up your financial records and record your income and expenses on a regular basis. Assuming that your historical data is in order, the next most critical information, whether new or existing business, is your cash flow projection and assumptions. Financial projections should reflect how the loan will impact business, either through purchase of additional assets, expansion of facilities and the capacity, or other loan purpose. It must be reasonable and include explanation, which is are your assumption. Reflect industry data to help assure that projection makes sense and can be verified by lenders. And the financial projection should demonstrate sufficient cash flow to repay the debt. Cash flow is an estimate of money coming in and money going out of your business, and the earnings and the payments. Be aware of unfair lending practices. A final caution, not all lenders operate fairly. Protect yourself by learning how to recognize unfair practices. Watch out for the following: receiving a loan offer that you did not apply for. Watch out for a lender who promises you loan approval no matter what your credit history or credit score. Watch out for being rushed into signing loan papers, and watch out for high interest rates and fees. Loan repayment terms that do not seem fair or appropriate include balloon payment, penalties for early payment, etc. Be aware of. Do not sign any documents that contain blank spaces. If you have doubts, do not sign anything until you have consulted with a lawyer or trusted friend and fully understand the terms and conditions of the loan you are being offered. So in other words, if it's too good to be true, it's too good. These are tips for achieving credit readiness, because this basically that's what we are saying during this whole window. We want you to be credit ready. Okay, you have to achieve credit readiness. And that requires work, preparation. We want you to think like a lender. If it was your money going to support someone else's dream, what would you want to know? Good preparation is key. You should be able to answer almost any question your lender asks. You must know your business plan and financial data. Never rely on someone else to speak for you. And again, a business plan and strategic plan is the same thing. Full disclosure is required. Address any situation in your business that may appear to be a weakness before the lender raises it, because we don't want it to look like to the lender that you're trying to hide something that the lender should know. Make sure that you have a good story to tell about your business, and then tell it with enthusiasm. So again, it's all on you to tell your story. Now that we have reviewed the 5 C's of credit, we want to hear from you. And they are, number 1, do you need to review any C's of credit after the module? Which of these do you find the most helpful? Thirdly, how do any of the specific C's of credit apply to your business or business idea? And fourth, what are some of the next action you'll take for your small business you learn in this module? You know how to get set to apply for a loan, what a lender looks for in a loan application, and what you need to provide. You know the 5 C's of credit now and why they are important. You know about a credit score and how to obtain a copy of yours now. That's what you learned during this module today. And you know what to avoid when you review a loan offer. So yesterday we put you in the ready mode. Now you're in the set mode. Tomorrow we're going to put you in the go mode. And these are those resource partners that's available that I mentioned quite a few times. Reach out to these resource partners. They can assist you. Go to their website, request online consultation, and they can assist you. I'm Easter Wright, and I've been your presenter for today. And you can follow SBA. This is our Houston District website here.